All right, so workings 4 will be our NCI. All right, so what is the NCI at acquisition?
9,000.
9,000. Okay, so that one we have it in our workings 3. It was 9,000. Then what do we do again? NCI share, right?
Yes.
Of post-app, which will be 25% on, what was the figure? 900, right?
900.
Yeah, so how much is that?
225.
225. Okay, what else again? There was goodwill. So NCI share of goodwill impairment. So if you remember, the last time yesterday we did consult P&L. If you have goodwill like this, you see, we picked the other one and we shared it in the P&L using what we had in our workings too. But if there is goodwill like that, you have to take up goodwill again before you can share the NCI portion. All right. So that is that. So goodwill impairment would be what, 25% of, I think the impairment was 3,800. How much do we have?
950.
We have 950. So in total we will have how much? Then let's come to 5.
8275.
8275. Don't forget this question has an associate. And those of you who have my book, you know the template for the associate. All right. So you start with group retained earnings. 100% is how much? So this is where you realize that if you go to the retained earnings for the group, the parent owned, you have to pick this and add this because you want to add reporting. So it will be 16,200 plus 11,000. Because that one you want at reporting. Just as you added this one together at reporting, you have to add this one to get at reporting. So I think, so when you add, I think you have 27,200.
200.
Yes. Then CI share of what? Post-act. Since there is associate, when you do CI share of post-act for the subsidiary, you have to do CI share of post-act for the associate too. So this is how you go about it. So this one, I think it will be 75% by 900, right? For the subsidiary. How much would that give us?
675.
675. Then you do for the associate too. How much do they own in the associate? So CI share of post-act associate. So they own 40%, right? They bought 40%. And now you need to go and look at the associate post-acquisition profit. So this is it clearly for you. Post-acquisition profit. But don't forget the acquisition was bought in the middle of the year. Please, do you see this? Do you remember when we did our group structure, you put some 6 months over there?
Yeah.
So for them, you realize that you can't do for the full year because it was bought in the middle. So for them, yeah, so you have multiplying 6,000, which is here, by 6/12. All right. So that is how you do it. Please be careful. Careful. The formula for post-acquisition for associate is simple. You need the retained earnings at reporting minus the retained earnings at acquisition. That is how you get post. The same way we do for the subsidiary. That is how you do it. All right. Now you could see that the retained earnings at reporting will be this one plus this one. So which in turn gives you 21,000. Then at acquisition will be what? This one, which is, but I always educate multiplying this thing by timing. All right. So if you do 15%, 15,000, that is what gives you. By the timing, it was 6 months. So you do 6/12. That is exactly what we've done. All right. So when you do that, how much would that give you? Yes, guys, be fast.
1,200.
1,200. What else? We've not shared the balance of this, right? The impairment. So after you are done with this, now you come to CI share of impairment. So this one too, had it been that there was impairment in the associate, you do the same thing. Okay, you do the same thing. So you have 75% by 3,800. If the subsidiary associate also had impairment, you do CI percent of the subsidiary impairment. Okay, so the same thing that you do, associate impairment, sorry. So please give me the figure.
That'll be 2850.
2850. All right, it is impairment, so we are taking off. Yes, what else? When I was reading, I saw some things. PAP.
No?
I saw PAP. So PAP somebody sold to. Yes, this is it. It says that at this date, the current account of Sanda was 3.4 debit. This did not agree with the equivalent balance in Sanda's book due to goods in transit invoiced at 1.8 that were sent by Picant on this. So they sold. They sold. So Picant sold, sent by Picant. So that is it. But it has not been received by Sanda. So there is PAP as with a subsidiary. Okay, PAP with a subsidiary. And they said that, so you see, sometimes it's not just clear cut. You have to read the story and understand it. Until after the year end, Picant sold the goods at cost plus. So you see, another thing again is sold, and you are giving us cost plus. What is cost plus?
Markup.
Markup. But they said sold, but they've given us cost plus. So that one,
It's margin.
yes, so that one means that you have to convert
It's
this
cost of
markup to margin. All right, so please take note of that. The PAP, so you have to do 50 plus 150 multiplied by, so this is the in transit, the remaining one is in transit, 1.8. So that will be the closing stock. We will adjust this thing also in the balance sheet. So I always tell you that treat the thing as the one who is supposed to receive what received it. Okay, when we get to the balance sheet, we'll tackle that. So please, what is the PAP value?
600.
600. Yes, what else again?
The gain on contingent.
Yes, the gain on contingent. So please, this is it. Something, so you see, as at the time you were agreeing on the contingency, it was 4.2. And this is a liability. Contingent consideration, fair valued at liability. Okay. Now, when the time came for you to pay the liability, it is 2.7. If you have a liability of 4.2, that's the time I over which you are 2.7 now. Don't you think you have some gain?
Yes.
That is the meaning of that. And like I said, those of you who have my book, I've done a serious elaboration on these things in your template so that, see, I can tell you that you won't see these things anywhere in any other book. I can confidently tell you that. Because if I if I let me see if I can see this thing for you guys to see. If I on my camera like this, you see this? You see all the FR books I have? 1, 2, 3, 4, 5, 6, 7. Even from Nigeria, not Ghana. You can't find it in those books. So please, and these things, you only find them in these ones. You see these big books. These are from the standard makers themselves. It is given out by association working with Deloitte. That is how they give. So every year when the publication comes, they will give you the book. Every year when the publication comes, they will give you the book. So if you don't read detailed, and I know you people are writing exams, our job is to read it and to bring it out to you. That is what we are supposed to do. You will not get the time to read this kind of big books. And then that is our job. We read it, we summarize it for you, and you people will pay us. That's the beauty of the job. All right, let's move on. So the gain, and even the book that I've done for you, you see PAP PPE. That one too, you don't see it in books. You don't see it. Have you ever seen PAP that is PPE before? Check the books that you have. Check the ICA books. I have them here. I just buy it to beautify my room. But when I read, you don't see those things there. And you don't know when in your exams this thing will come. You don't know. All right. So the gain, which is 4.2, that you have now realized at 2.7 will be how much?
1,500.
1,500. All right. So that is how this one goes. Now you can now close it and give me the. What will be your working 6?
Investment in associates.
Yes, investment in. So that is why I'm saying that. See, you can pretend as if the investment in associate doesn't exist because we don't consolidate associate. You just present it as a one-line item in your SOFP. It's just like doing IFRS 11 joint venture. You don't consolidate it. You just present it as one-line item in your P&L and your. So here, the only item that will come from our associate in your P&L will be the dividend that you receive. Okay, then the in your SOFP it will be your the working 6. When you do your working 6, the value that you have, your investment in associate. That's all. All right. So get me the figure here. Now let's do the investment in associates. All right. So we
The
have
figure is 27,000.
it's how much? 27,000.
Yes, 125.
125.
25.
Okay. So investment in associates. What is the purchase consideration? So the purchase consideration in the associate, this is where you find it from. They said that they bought 40% of the shares, paying 4 CDs. All right. So first one, we have 40% of the shares. What is the shares of the associate? Let's go and see.
5,000.
Oh, I'm going wrong way. This is the share. So 5,000 over 1 is 1 CD. And they bought this thing at the price of what is the price? 4 CDs. 4 cedis. So 4. So how much would that one give us? So that is 1. It did not end there. It said that they also acquired an issuing at par 107% loan note for every 50 share acquired in Adler. So you have to get me the number of shares acquired. So this is it. So 40% of the 50. So they said that for every 40% they acquired, which is 40% of the 5,000. So that is what they say over here. So that one, you are dividing it by what? So they issued 100. So we have to multiply it by 100. And they said that for every 50, so for every 50 of the 40% acquired, they are giving out 100. So that is that. That is just like the way you do the share for share exchange in the working street. The same thing. It's just that this one is a loan note. So that is what is happening. So for the 7% loan note. So it says that the issuing at par 100 share 7% loan for every 50 shares acquired. What is the acquired one? It is 40% of the shares. So you do 40% of the shares. Then for every 50 of that 40% of the share, they are giving at par 100 cedis. So that is that. So please give me the two values. Then you bring now this one, the CI share of the post arc, which is here, Workings 5. CI share of post arc, which we've done in Workings 5. That one is straight 1,002. All right, so please give me the two figures. So please, some of you need to go back and watch your associate video. Okay, my question on the share exchange, I had 12,800. So you have to tell me how you did it to get it. All right. Yes. So you have to explain how you arrived at your own so that we can help you. And that is why I'm saying, if you have a challenge, so please, this is not a teaching class. This is a revision class. So please, if you have any question, ask. So zoom in. Let us hear from you how you did it. If there is any help, we can help you. All right, guys, give me the figures.
8,000. The first one is 8,000.
All right. The second one,
4,000.
4,000. So in all, 8, 12, 13,200, right?
13,200.
Yeah.
Yeah. So you are done with your workings. Now you can go straight and start putting the figures in your balance sheet. You can start putting the figures in your balance sheet. So please kindly have these figures in mind. We are going to go into our balance sheet and prepare the balance sheet. Okay, so I'm seeing what you are saying. All right. So you said 75% of 8,000 by 2. I think the problem is your ratio. Is it by 3 or by 2? I think the problem is your ratio. So you should learn how to read the ratio. It's very, very important. I have, when I was writing ICA exams in those days, these things were a challenge to me because I'm an average student, and and these things were a challenge to me. But you see, you have to take your time, and you have to read the thing and understand it. Okay, so I decided to take my time and read. When you take your time and read it, you realize that it's that simple. And you can start now. When you understand it, you can now speed it up and speed it up and speed it up. So that is how it works. So Michael, so this is it. So this thing, it happens to almost all of us. Okay. So this is what it says. It says that they bought 75%, which you had right. Equity share in a share for share exchange of 3 shares in Picant for every 2 acquired in Sanda. So what you are showing me here, so it is the 2, it is the 2 that is supposed to be the denominator, not the 3. Okay, you should be multiplying by 3, not the 2. So your challenge is just how to read the ratios. So the question, so it's very simple. So it is saying that, so for every 2 they have in Sanda, how much do they have in Sanda, and how can we do the everything? So they said 75% of the Sanda, which you had right. So the 75% of the 8,000, yes. Now for every 2 inside this 75%, they are giving out 3. So that is how you read it. Okay. Of course, see, if you want to go straight away, then please do it 3/2 into bracket 75% of the 8,000. So Michael, that is that. Okay. So for every, so the denominator is what they are acquiring in the subsidiary. That is to always be the denominator, not what the parent are giving out. All right. What the parent is giving out is the multiplying figure. All right. So please, try as much as possible. I am tempted to believe that you owe me money. That's why. So, because this thing is elaborated in the console videos. All right. So please, WhatsApp me under G. All right. Okay. So now let's go ahead and prepare our SOP. So please have the figures in mind. We will be solving the next question too today. We started early today, so, and today the only match there is just Man United. There's nothing to write home about. So all right, so let's conduct our SOP. Please, when you are solving it in the exams, kindly do Picant group consolidated statement of financial position as at. All right, then you put the date. Okay, so please do that. Okay, so let's roll. Let's roll. So we start with our NCA. We start with goodwill. How much is goodwill from our workings 3? It's how much? 12,000, right? Guys, I hope you copied it. Let's be together.
12,200.
12,200.
Oh, 200 count.
Mm.
All right, so that is fine. Yes, the next thing, so go and check the workings too. What were some of the things at reporting we can bring? The workings too.
Fair value adjustment.
Before the fair value adjustment, okay, so there's fair value adjustment. No, the fair value adjustment is PPE.
Mm.
So
Yeah.
PPE, but before the fair value adjustment, there was an intangible write-off. Since we are doing intangibles, let's start with intangibles.
Okay.
And I remember that one was 500. Then the PPE can now come. So you add line by line. So let's go here. So PPE line by line. Please don't consolidate associates. Plus 24,500. The only thing that comes from the associate is the investment in associate at work in the SOFP. In the P&L, it is only the dividend. So guys, just a minute. Hello. Yeah. Let me call. I'm in a Zoom class. Let me call you back very soon. Bye. All right. So fair value adjustment was 2,000, right?
Mm.
Okay, so then we take off the 100 depreciation. So you give me the figure. Then we come to our current assets. Current assets, we have inventory. Don't forget there was PAP on the inventory, and there were some goods in transit per the question. That one was inventory.
Mm.
Yes, so let's do line by line. 10,000 plus 9,000. Then the in transit. Please, I said whenever you have in transit, treat it as whosoever was supposed to receive. So if they are to receive, they'll receive 1,008.
Mm.
All right. So this is the goods in transit. Okay. Then the PAP was, I think you gave me 600 in workings 5. All right. So give me the figure. Then let's come to the next line here. I think it's receivables. Receivables. And it says some things about current account over here. I pray we finish this thing before the time is over. This is it. So the current account with Sander, Picant current account with Sander had 3.4 debit, which did not agree with the equivalent in Sander's book due to him. So it means that who is supposed to receive in this scenario? The current account is debit. What does that mean? They did not agree. So if it did not agree, then this one is the reason why it is not agreeing. So now you have to, what you need to do is to write it off. So this is not the reason, and the reason is because of some inventory. So what you do is that, so let's do the line by line. Then we will write the current account debit off by crediting it. So we write this one by crediting it. This is a debit. We write it off by crediting it. Now, then when you do that, the difference between that 3,400 and this 1,800 plus this 1,800 will give us how much? And that is what you write off in the current liability. All right. The PAP is the PAP. It has nothing to do with this.
1,600.
Yes, so that is what you write off in there. I've always told you that always do those kind of cancellation. All right, so let's go to our receivables. Receivables, we have 65 plus 15, then minus, so we are canceling it off. That one was a debit. We are canceling it off by crediting it. Then the relationship between this one and this one will be what you will do in your current liability. So please give us the figures. This is intra-group cancellation. Let's go to the equity. Oh, sorry, there is associate. There's associate. So associate. Investment in associate, our working 6. I think we had that one, I remember, is 13,200. That one is part of your CA. Please get me the figures. Let's hurry up. We have like 4 minutes. Oh, guys, the figure.
For the CA, inventory is 20,200.
Okay.
And then receivables, trade receivables,
It's what?
4,600.
PPE, please.
PPE,
63,900.
So the total will be how much? Let's balance off. Then we can start with equity. So stated capital is there. Just pick it up. Share premium is there. We just pick it up. Group retained earnings, workings 5. I think, how much was this? Give me that. Then NCI workings 4.
Group retained earnings 27,125.
7125. Yeah. NCI
8275.
8275. So you can total that one. Let's put it here whilst you do this one. Then NCL 7% loan notes is here. Um, 14,500 plus 2,000. So I think it's 16,500. Then CL, the CL, you have less than 1 minute. You guys have to rejoin.
Contingent.
The contingent. Okay. The contingents It was now 2,700, right? Yes, by the time it got to that place, then the other CLs,
300 plus
the other CLs, we have
8,300.
8,300 plus 7,500
7,500.
minus this and this,
16.
600. So how much would that give us? And please get us the balance.